Good day, students. We're starting off with the first session for management accounting, where we're going to be going through different cost concepts. And in accounting, we sort of had touched on the income statement and sort of how sales ties into cost of sales to then produce your gross profit. So now what we're trying to do is drill down into this cost of sales account and say, what is actually made up of cost of sales and what are the other operating expenses that then come through not in the cost of sales line but in your other expenses line item in your income statement. So just to first go through the different cost concepts, we first got direct costs. These are expenses that are directly going to producing goods or providing services. So part of direct costs, you can have direct labor, you can have materials or any other manufacturing supplies that are used. And these are exactly going into the operation when you actually think about the floor and the manufacturing process and the actual production going through. What are the materials that are being used? What is the labor that is being used? We then have indirect costs. Indirect costs are general business expenses that keep the business operating. So examples of these would be rent, electricity, general office expenses. And then we've got product and period costs. Our product costs are made up of costs related to the production of the product. So your product costs can be either direct or indirect. And then your period costs are any other costs that are incurred. We've got overhead and sales and marketing expenses. These are examples of some of the period costs that one experiences. Let's look at an example of sort of what are the direct costs that we were talking to in the previous slide. So we mentioned we've got direct labor, we've got materials and supplies. Okay, so as part of direct labor, these are the wages and these are any other costs that are paid to the employees who are involved, as I said, on the production process. So you've got any assembly line workers, your painters, your welders, anyone that's actually physically working on the product, they are known then for the direct labor costs. Direct materials, any raw materials that you're using to actually manufacture the product. If we use an example here, if you're producing rocking chairs, the wood that you then be using to assemble the chair would form part of your direct material cost. But think about any other supplies that you would need, which wouldn't be a material. We'd also need supplies such as glue, nails, varnish that will be used to assemble the chair. These will form part of then your direct supplies cost, which also form part of your direct costs, which form part of your cost of sales. Then we've got factory overheads, which we encounter. If your production facility is then located in a specific region, any costs within that factory, whether you're paying rent on that factory cost that's included in the product cost, whether you're paying a security guard, whether you're paying gas and electricity, because we're using this for the specific manufacturing facility, these form part of your factory overhead. Any other factory overheads also form part of this costs that are then allocated within your cost of sales. So whenever we're thinking of cost of sales, we're thinking of which costs were actually directly attributable to producing or manufacturing that rocking chair. We're thinking of the wood, we're thinking of even quality line workers that might form part of your overhead. So if you've got someone who's sitting there supervising the production process and who's making sort of recommendations, even though they're not physically touching the product, they're involved in giving their advice. That inspection or quality control officer will also then be included as part of the factory overhead. So we've got direct labor, material, supplies, and we then have this factory overhead, and the factory overheads needs to be related to the manufacturing facility itself. It cannot be part of the head office or an admin building. We need to only allocate the costs that are relating to that manufacturing facility. So if one were to look at an example of an income statement, we've got sales, cost of sales to then produce your gross profit. And now, as part of those cost of sales, we said is made up of, we've got product costs, which form part of the cost of sales at the top, your period costs, which are any other costs that you're incurring that have nothing to do with your manufacturing facility, that are any marketing costs, any head office costs. These will then form part of your period costs. But we need to remember, then as part of the cost of sales product costs, these are made up in two categories. Here we have either direct costs, which are direct materials, labor, and supplies. And then we also have indirect costs, which are also known as your manufacturing overheads. We've gone through detail the types of manufacturing costs, which I've mentioned are materials, labor, and any manufacturing overheads. Let's now look at the example on the left. ABC produces and sells handbags. The company produced 3,000 handbags. So your production for that year versus your sales. You produced 3,000 handbags, although you only sold 2,600 handbags. Now they've given you the costs to detail. Each bag is made by temporary laborers that are paid 150 per hour, and they spend 90 minutes in making each bag. So one bag, you're spending 90 minutes. 90 minutes is equivalent to an hour and a half. And if you are paid 150 per hour, your direct labor will then be 150 that you are paid. And for one bag, you need an hour and a half. So we times that by an hour and a half. And we've got 225 per unit per bag. The direct material that they're giving you above is 375 per bag. So we can insert that in direct material. And then it says total fixed manufacturing. So their manufacturing costs that have gone into also producing these handbags, they amounted to 900,000 for the year. Okay. So they've given you the total cost here for the year, and you know you've produced 3,000 bags for that year. So how we calculate our overheads per unit here, we take the full 900,000 cost, we divide it by the number of bags that were produced, and we get to 300 overheads per bag. If we sum up the 375 direct material together with the direct labor and the overheads, one handbag is costing us 900 Rand. Okay. If we look further in the information, the last sentence tells us that the markup of 80% is levied on each of the handbags. So the 900 multiplied by 80% to get the markup, you get a markup of 720 Rand, which means your selling price was 1,620 that you want to then sell these bags for. If we're to then go further down into the information, we'll notice that the sales were 2,600 units, and now we've calculated our selling price. So if you look further here on the right, we've got 2,600 bags, each sold for 1,620. We've got 2,600 bags of cost of sales, but remember the unit production cost is only 900. Remember, for your cost of goods sold, we are only putting in cost of goods sold, not the amount that was produced of 3,000, but only the portion that was sold, and we've only sold 2,600 bags that year. We then get to a cost of goods sold of 2.34 million. Okay, once we subtract that 2.34 million, we get to a profit of 1,000,872. That gives you a gross profit of 44,000. If we are to then look at other costs that they have described here in the example, they told you that you've got audit fees and head office salaries of 550. So 550 is your head office salaries and your audit fees are 550. And then your sales representatives are paid 10% sales commission on sales. So if you look at the commission, how I've calculated it, is 10% of the sales that have gone through. You get to a sales commission of 421,200. These all together make up your period costs, whereas these make up my product costs. If I total up my period costs, I get to operating costs of 1.52 million, and that gives me a profit before interest and tax of 350,000. So basically what we've detailed here is within the cost of sales account. Remember, we've got 3 types of costs that go into that cost of sales account. We've got your direct material, you've got your direct labor, and you've got your overheads. This would give you then your unit production cost, and what goes through cost of sales is only the amount that was sold during that year, which would mean that if we produced 3,000 units and 2,600 units were sold, our remaining units are sitting at 400 for that period. And then if we were to multiply that 400 times the unit cost, we've got around 360,000 worth of inventory that was produced that has not yet been sold during that year. This gives clarity on how to actually split out your income statement when you're looking at the sales and the cost of sales. As you can see, we've added all our direct material, direct labor, and any indirect costs, overheads that are manufacturing. These have to be manufacturing overheads. And then under operating expenses, we've included here the audit fees, the head office salaries, and any sales commission. And these form part of your period costs. And we're then able to calculate the profit or loss for the period. Okay, for a service organization, the question is, do we have sales? Do we have cost of sales? Do we have direct materials and direct labor? So yes, in terms of sales organization, you might not have actually a cost of sales in terms of the sales of actual products that you're selling. You might make actually in that instance a service revenue. If you then have a service revenue, you've got costs of producing that service. If you then have to pay employees any labor for producing that service, then that will form part of your direct labor to actually perform part of those fees. So if we're looking at a hair salon, some of the fees that we're earning from all the hairstyles, that will form part of our sales or service fees. The cost of service will be all the costs that we're paying to the actual employees that are physically actually doing the hairstyles. So if you've got someone who's physically preparing the hair, blow drying the hair, those form part of the direct labor. But then you've got some other employees that potentially aren't actually servicing the clients. Those might form part of period costs, so any other salaries and wages, someone who's preparing the accounts, doing any other administrative work. Yes, those are labor costs, but those might form part of the period costs. And then we can sort of in a similar way set up a service organization to an organization that is selling products and services. Okay, if we looked at our manufacturing overheads, so here we had allocated 300 per manufacturing overheads. Manufacturing overheads, because they're indirect, we need some way of allocating them. So in this example here, we had allocated them purely based on the number of handbags. So we just said 900,000 that we produced divided by the number of handbags. But an easier way of actually looking at that cost allocation is to look at 2 different types of cost allocation techniques that we'll be covering in the next session. The 2 types of cost allocation techniques are traditional and activity-based costing. I will then detail an example in the next session covering the 2 different types of cost allocations. But for now, just know that cost of sales is made up of direct materials, labor, and an allocation of those overheads relating to the manufacturing cost. Thank you. See you in part 2.